So glad you are with us on the Allon Exchange. Brad Johansson, along with Jane, Brittany Hagy, Allon Planning Partners. Guys, nice to be back with you.
Hey, Brad, so good to have you with
too.
us today.
How are we today?
Great.
We are good.
What season are we in?
We're always in a season, Brad. This season we want to talk about is tax season.
I had a feeling. I had a feeling.
I don't
tax
care
season.
when we're talking about this. It's December, it's tax season,
Yeah.
right? It's always tax season because tax planning is not just a season, it's a strategy.
Okay.
You have to make sure you have it.
Look, you may be heading into this as we go. I'm going to wait till April to be in tax season, and I know what Jay's going to say to me as I move into this. You do not wait for April. So we're not waiting for April to be in tax season. This is a season that if you don't plan for it, look, there's tax prep, right?
Yep.
And then there's tax planning. April is for that final prep. How do we move into it's always tax season by saying we need to set a foundation for this because this is going to be your season for the rest of your life. You better manage it well.
Well, a lot of folks treat tax season in the IRS like a pop quiz. Like, yeah, pop quiz, I'm going to see how well I can do year over year. The IRS grades on a different scale. They don't grade on a pop quiz scale. They grade you on how well you've prepared years and years before.
Sure.
Right? So you have to prepare for years before you ever get to the pop quiz of the prep day, right, in April. So that's why we like to put together tax plans that are long, that are not just a runway of a month or 2 months based on what happened last year, but a tax plan that creates strategy for the next 5, 10, 15, 20 years of your life. So that way you can do better when the IRS grades you to say, save me money on my taxes.
And there are things that we can be doing over time to actually set ourselves up better for that time when we do have to pay. The earlier you begin tax planning, the more options you will have in having control over when and how you pay taxes. A lot of folks talk to us and they're like, well, I don't have control over taxes. I don't know what the tax rates are. I can't change any of that. Well, we might not be able to change tax law, but you do get to control when you pay taxes. And this is where the actual planning comes into play, not just paying, but planning. And when you begin early, you have many more of those options available to you.
I want to move into because I got an income. I have a feeling I know where my income's going to be. It is what it is. I'm going to be lower your taxable income throughout the year. How do we do that?
Yeah, it's a couple different ways, right? And we do dollar cost averaging with our investment accounts all the time. We spend dollars, not just one lump sum at the end of the year. I'm going to put $30,000 into my 401k in December, right? You do that over the full year. So dollar cost averaging also helps you lower the amount of taxes that you're paying month over month, right? And so you can have a better strategy going ahead with that. There are many. You don't want to treat, tax day like, brushing your teeth, basically. You want to brush your teeth every day, not just one day a year. And so you want to make sure that you're taking advantage of every tax saving opportunity that you have every day of the year, not just
and I want to clarify that because as we talk about, the last thing people want to hear is it's always tax season. I get it, right? Like I don't want to always be tax planning. But here's the thing, it doesn't mean that you're always tax planning. It means that if you take the 30 minutes, the hour and a half to sit down with someone like us, sit down with us, and we put a system in place, we put an actual plan in place, strategy to ensure you're not overpaying in taxes. It's working for you so you don't have to. So it's not, when we say it's always tax season, don't think, oh, I always have to be thinking about this. I always have to be worried about this or planning. You don't. If you do the initial work up front, it's going to work for you. You put the plan in place, you put the strategy in place, and it works it out for you where you're not constantly having to think of it yourself.
Most of my stuff is what people will say, is in investments. How do I optimize my investments when it comes to taxes?
Yeah, well, first you want to make sure that you have different buckets set up for your taxes. You want to make sure you have some tax deferred buckets, some tax tax-free buckets and some taxable buckets, right? Because these three buckets are going to be looked at differently year over year and over the long term. So tax deferred means I can take off my income taxes this year, every dollar that I put in this tax deferred bucket, right? Tax-free means this year I'm going to pay taxes on this Roth bucket, right? But the growth going forward for the rest of my life, as long as I have this account and pull from it, will now be tax-free dollars that I can gain. And so you want to have different buckets set up so that you don't have all of your money and all your eggs in one basket, so that you have diversified strategy when it comes to taxes, just like you do your investments. You wouldn't never want to just put all of your assets into one stock or one company, right? That wouldn't be any diversification. Why do we do that with our taxes? We do that so often in our tax deferred buckets. That's the only one we ever pump in and the only one we ever look at. So we have to have diversification of tax buckets.
Roth conversions, people will talk about doing at the end of the year. I'm trying to figure, did they work better if we start doing conversions over a full year? Is that a logical strategy?
Well, what really works is when you're taking advantage of, we talked before on a show, Brad, about this runway, taking advantage of the full runway as we are preparing for retirement and what it actually looks like. This is a way that you can take full advantage of that runway. Use multiple years when you're looking at Roth conversions. So basically, just really quickly, the core concept behind this is taking dollars from your tax-deferred accounts, like your 401ks or your IRAs, and moving them over into Roth accounts. When they are in Roth accounts, you pay the taxes now at the current year's tax rate, but they go into this Roth account and they grow tax-free. So not just distributions are tax-free later, but the growth on that account is tax-free later. That's the tax diversification Jay was mentioning earlier, right? So utilizing that over a period of years, taking sums of money over a period of 5 or 10 years and converting smaller chunks at a time really makes the most sense, rather than taking big lump sums and incurring a huge taxable liability. That's what we want to avoid in all this, right? That's why we're doing this to begin with. So we don't want to take huge sums of money and pay a 50% tax or 40, high tax on what that looks like, and doing it in a lump sum. Spread it out over the full runway.
Let me give you an analogy, because to me, I don't miss many meals. I like to eat, I love good food. And really, Roth conversions over years, a period of time, should be like smoking a brisket, right? You want to make sure it goes slow and low for a long time because it bakes in all that flavor. And you're going to have juicy meat by the time you get to the end of the 12-year period.
I'm hungry.
When 12-hour period
my stomach's
from that.
growling.
But I love a good brisket, but you have to slow burn this thing. The same with Roth conversions. Brittany just said it. You wouldn't want to take your investments and assets and take all of your deferred money in one year and say, let's just cook this in this year and go ahead and pay the taxes. It's not going to taste great, okay? You're going to owe the IRS a lot of money. You need to make sure that you're dividing that up year over year over year, and we create a laddering strategy so that you can take some of these deferred dollars and get them into tax-free dollars by paying lower tax rates. That's what we're getting to. And so I like to look at it like smoking a brisket, because it takes some time.
I like that. I think it's about dinner time.
Yeah, probably.
Well, on that note, we've created a tool, Brad. I would love for us to talk about this. We've created this tool that helps folks really see what their taxable liability is. Visit Exchange My Tax Bill. Again, it's on the screen there, exchangemytaxbill.com. You can also use that QR code. But this is a tool that we have designed to help you see what your taxable liability is. How much of those accounts that you are currently holding actually don't belong to you? What will be owed in taxes on those? This is a tool that helps you not just see that and help you see your starting line, but also gives you some ideas as to what you can be thinking about as strategy. What's the action step that I'm going to take behind this? How can I actually work to strategize, tax plan instead of tax pay? Visit exchangemytaxbill.com. Brad, that's a great resource that we have for folks.
I mean, you've simplified it. It's a simple tax calculator that you can go to, and in just a couple of minutes, you have an understanding of what I have and what's not all mine, what Uncle Sam wants, and how can we strategize, as Brittany says, to keep more of this money in our pocket. We've talked about it all the time. The longer the runway, the more options that you are going to have. So I know taxes aren't fun to do, but wouldn't it be fun to have no more taxes? And if you can plan now to get to that point and grow the money that is all yours, tax-free for the rest of your life, doesn't it sound optimal? That's what we're looking for, is to create a plan for you that is going to work in the best way it can, and your plan isn't going to be like any others. Then you're going to want to call so that you can go to the spot that you need to go, and let's put a plan together for you. Jay and Brittany are doing it all the time, and that perspective matters for you. Let's put that plan together for you now. You want to talk more about the plan? Because it's always tax season. We'll do that when we come back.
Do you know how taxes will impact your financial future? We meet with many families day after day who have saved years for retirement in a 401k, 403b, or an IRA. But they come to realize they don't truly have a financial plan. They have questions like, how do I turn my money into income streams to last me through retirement? How do I know if I'm best positioned for market volatility and inflation concerns? And how do I ensure I'm not overpaying in taxes? This is one of the greatest tax windows in history, and now is the time to take advantage of this discount while you can. The good news is we specialize in areas such as proper portfolio allocation, retirement income strategies, and tax planning. When you meet with us, you'll walk away with solutions, with answers to your questions. You'll walk away with a written, comprehensive financial plan. Reach out today for your complimentary portfolio review and tax analysis.
You've worked hard for your money, so it just makes sense that you would like to keep as much of it as possible. At Allon Planning Partners, we can help you avoid common tax mistakes. We'll work with you to minimize your tax burden in an effort to maximize your income in retirement. We will ensure that you have a comprehensive written financial plan. Call the number you see here for your complimentary consultation.
So glad you are with us on the Allon Exchange. Brad Johansson along with Jane Brittany Hagy, and we're talking taxes. We have to make it better. So, and changes are the permanent. We constantly have them. Government loves to do this to us, right?
Oh, every time.
So we got tax code changes and stuff in 2026. You want to lead on the way of that?
Well, and every time the Congress updates the tax code, you're going to have two categories of people. You're going to have confused people and prepared people, right?
Yeah.
Who has time to read a 1,000-page bill?
Right.
I guarantee you the people that passed the bill didn't even read the whole bill, right? Interns write most of this stuff,
Yeah.
and then it gets passed. But what I will tell you is we want to help our clients be prepared. We don't want you to stay in the confused category. We want you to be prepared. And tax law will continue to change, right? What this newest tax law did is really a gift to us, right? Because that gift made sure that we had predictability going forward, meaning that we are taking the 2017 Tax Cuts and Job Act's brackets and making them permanent until it's changed again, right?
Semi-permanent,
So
right?
semi-permanent. But that 10%, 12%, 22, 24, all the way to 37, those brackets become permanent, because if that law wasn't passed, we would all automatically be in higher tax brackets. So that gift give us great predictability going forward for our planning.
Yeah.
And so we're able to plan better because we know the brackets are going to be at least semi-permanent going further. It also makes the Roth conversion window that we talked about more reliable. So you can actually know and how to plan how many years can I convert my Roth and keep under a certain tax bracket, right? Convert to a Roth, convert my tax deferred dollars to tax-free dollars and stay under the tax bracket that I want to stay under.
Right.
So it's a great gift to us to be able to prepare. But there again, if you don't know these changes, you're going to be in the confused category, and we don't want that.
Yeah, and one big one that we walk our clients through is the increase in contribution limits that is allowed. So there's been an increase as to what you can contribute to your IRAs, to your 401ks, those types of tax deferred accounts, as well as Roths, right? All of these accounts have contribution limits. And so those have increased for the year. For those who are over the age of 50, you have additional catch-up contributions that are available to you. that are not available to those that are under the age of 50. So all of those things considered, contribution limits have increased. Like for your 401k, you're looking at well over $30,000. 32.5 is close to that new bracket there where you can actually put that much into these accounts. So you, especially for those who are feeling like they're a bit behind, man, this is a way that if you are still in your higher wage earning years, you're kind of at the end of your career, stack that away now. That is a way that you can contribute more to your future income, future experience when it comes to your finances, and be able to take advantage of the increase that came with this tax bill.
And we do want to make our viewers aware of a couple more changes
Please
that were
do.
made in this bill too, because one of those were the increased standard deduction, meaning that for a married filing jointly couple like Brittany and I, we get to write off the first $32,200 this year in 2026, right? If you're single and listening, that's $16,100 as a standard deduction, right? That is huge. These standard deductions are large and they continue getting larger with inflation, right? But listen up, if you're 65 and above, which is the majority of the audience that we have coming into our office every day, if you're above 65, you have another standard deduction. You get to add on another $6,000 per individual. So if you and your spouse are both 65, that's another $12,000 that you get to deduct. So you're talking about $44,000 that you get to deduct just as standard deduction. That is huge for those people that are on fixed incomes that do not have the extra money to pay the taxes, right? You're going to get a bump up, and there's going to be a large tax refund coming to you next year.
We have to deal with Social Security on this, and people are trying to figure out how that works. Is there something new with that within this bill as well?
Well, and that tax deduction right there, that senior provision is actually what it helps to counteract most folks' Social Security. So over 88% of folks will not have to pay taxes on their Social Security because of this provision. So it makes a big difference in the bottom line as to what you get to keep when it comes to your Social Security dollars. That's a big benefit of this bill.
Higher income earners are always wondering about, hey, how about a little something for me? Do we have anything within this bill that works?
Yeah, well, here's a big one, is the federal estate and gift tax exemption went hugely up. It's up to $15 million per person.
How about that?
So if you've got a lot of money that you're passing on to your kids or your grandkids or your heirs, as a married couple, we could pass on $30 million without the gift or the estate tax added. So that is a huge benefit. Some of the state and local tax deductions have increased a little bit for those who pay those, but like the majority of that federal estate and gift tax exemption is for the very wealthy individuals that have a lot to pass on to their heirs, that they don't want to get burdened with another 50% tax, in the estate tax.
Well, and I have to say, if you're looking at this whole tax situation, and people may be thinking, why are we spending so much time talking about taxes? What's this have to do with, investments and financial planning? It has everything to do with it, because all of these pieces really are so interconnected. Your investments and your income and taxes, all of these things impact one another. It's like dominoes. One just knocks the next and it knocks the next. Here's an example of that. If you are looking at your taxes and you have investments that you are not strategizing on how you can lower your taxes, the taxes you are paying on your investments, you will end up paying more than is absolutely necessary, which impacts your income. It impacts how long your savings is actually going to last for your lifetime. So if you minimize those taxes, you're able to keep more in your pocket and make what you have actually last longer over your retirement years. So they really all are interconnected. So that's why we spend so much time talking about this whole tax update and why it even matters. That's the bigger picture here.
The idea is, if it is a domino effect, and we've talked about the domino effect on multiple shows, because if you don't have a plan in place and you're missing something within the plan, the dominoes fall very quickly. Taxes are always going to be a part of that. So how do we use some of these changes to strategize a little bit more in our investment plan, in our long-term strategy? We're going to talk about that when we come back, but you need to call the number on your screen or scan the QR code right here so that you can pick up your complimentary financial review. It's what they do every day. And the idea is yours is going to be different than everybody else's. You've been waiting to call. Make that time now. Make the call. Scan the QR code. Let's put together a plan for you. We're back after this.
Hi, I'm Jay Hagy, owner of Allon Planning Partners. Well, you've probably heard a lot about Roth conversions lately. First of all, what are they? And second of all, how could they benefit you? A Roth conversion means getting your money out of those tax-deferred accounts like 401ks and traditional IRAs where you've been kicking the tax can down the road for so many years. But really, the question should be, is kicking it down the road really in your best interest? You have a partner in those deferred accounts. It's Uncle Sam. And Uncle Sam is going to take his cut from every dime that grows in that account when you decide to take it out. So let's give Uncle Sam the boot from those retirement accounts and let every penny of future growth be tax-free. Well, with the highest national debt we've ever seen, taxes are not likely to decrease anytime soon, placing a giant tax bullseye on your back. So a Roth conversion is getting your money out of those tax-deferred accounts, paying the taxes now while they're on sale, by the way, and then getting them into accounts where your future dollars can grow tax-free the rest of your life. To experience this tax-free retirement, you do need to sit down with a fiduciary, someone who specializes in retirement planning. So just call the number you see here or scan the QR code and let us help remove that tax bullseye off of your back.
It's always tax season, which is why we're talking about it, to try and help strategize for you. So we have very little time, but we want to get to. Guys, how does this become practical? How do the changes help us strategize? Start me off.
Well, we've talked about higher standard deductions. We've talked about the senior deduction, the 65 and older, you get an extra deduction. We've talked about how we are in the lower tax brackets. You know, the withdrawal sequencing in our retirement planning and our income is more important now than ever, meaning that if I've got all of these standard deductions piling and say I've got upwards of $45,000 to write off above the line, my first $45,000 is tax-free. I may want to withdraw more from my IRAs and do Roth conversions on those IRA dollars and maybe even pay zero taxes to do a Roth conversion, or at least in that 10 to 12% range. I don't want to say ever because you can't, there's nothing guaranteed here, but it's going to be hard to find a lower tax bracket to convert a Roth in than 10%.
How about that?
And so if you are in a lower range and you're just withdrawing IRA dollars and you can write off the first $45,000, why not utilize that to do a Roth conversion to where you can have a tax-free implication on that Roth. So anyways, that is a retirement strategy that we need to be looking at. That withdrawal sequencing matters more now than ever. It makes those IRA dollars more accessible at lower tax rates. And so utilize your income plan at a different level under this bill.
Well, and of course, the Social Security piece, right? The Social Security becoming less taxable for most folks. As we mentioned before, 88% of folks are going to experience that. I mean, that's big too.
Massive. Legacy and charitable. I say this many times, that the legacy plan is the tail that wags the dog because people leave it for last. And yet, if our runway's longer, this gives us some time to do some legacy planning within these changes as well.
Yeah, this is, we mentioned one of those adjustments from the big beautiful bill in the previous segment, talking about how the estate tax and all that has really increased. So helping us find ways to actually give more, pass more on, not just when we pass away, but during our lifetimes. We help so many families who are coming saying, hey, we want to give this to our families, to these charitable organizations, to our children during our lifetimes, not just when we pass away. These allow for those opportunities to do so, utilizing things like QCDs, qualified charitable distributions, strategies that impact our taxes, giving those distributions and like RMDs coming directly from the institution to the charitable organization instead of coming to you and becoming taxable to you. Man, there's things like that that can really make a difference in your overall tax bill, but actually being able to pass legacy, pass, that purpose with your dollars, making your money not just work for you, but benefit other people along
Yeah.
the way as well, right? So it's grown and it's worked for you over your lifetime, and now you can really utilize that to leave legacy with your family, legacy with charitable organizations,
Yeah.
through all these different ways and methods of giving.
So Brittany mentioned QCDs, qualified charitable distributions. I want to also highlight donor advised funds. There are different strategies that we can utilize to structure your charitable giving so that you can pay less in taxes. And so we had one client last year that we helped them set up a structured plan to their charitable giving instead of just, hey, I'm going to write a check every year like I
Right.
do. They funded this year's giving and they saved enough on taxes to fund next year's giving too.
Wow.
So think about that. They basically doubled their funding to the charitable organization that they were serving in order, just by structuring it different, just by labeling it different. And so these things matter. This legacy plan, this charitable gift strategy, they matter because it's putting dollars out of Uncle Sam's pocket into your pocket or into the pockets of the people you love, the charitable organizations you're trying to help grow. So we can help you with those things. We can help you organize your charitable gifts in a way to where you can give more or longer.
You talk about this, and taxes scare everybody. And your final point is, let's do bracket management over bracket fear. The idea is, let's own what we have, figure out our best ways, because we have options.
That's right. You really do have more options for tax paying than you think. And it all has to do with timing. You get to choose when and how you pay those taxes. We can't impact tax law. We can't change tax law, but you do get to choose when and how you pay those taxes, which is why the planning matters so much, which is where we come into play. We have an incredible team of fiduciary advisors that walk our clients through these types of conversations. How can our investments be structured to help us tax-wise? How can we pass on what we have to those that we love and care about in a tax-efficient manner to make more of what we have? It's
Guys,
possible.
And a lot of times it's just about being intentional. It's about understanding what you have in front of you, understanding the new tax law as it is, and making intentional steps to pay less in taxes and put more in your pocket.
Want to pay less? Make the phone call. Scan the QR code. Let's come in and put a plan together because you have options. Let's play with the rules that you know you have right now. Thanks for your time. We know it's valuable. Now let's see you in the office and right back here next time on the Allon Exchange. Thanks for being with us. See you next time.